Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to the degree of operating leverage using an alternative formula for the calculation. This alternative formula for the calculation may be useful if we're Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to the degree of operating leverage, this time using an alternative formula for this calculation. This alternative formula for the calculation may be useful if we're external or outside of the organization and don't have access to putting together a contribution margin type of income statement, but rather have the publicly distributed informations that are going to be in the normal format, meaning rather than having a contribution margin income statement, which is sales minus variable cost, contribution margin, we have a normal income statement, sales minus cost of goods sold, gross profit, and so on and so forth. Then we might use this alternative formula in order to get to the same kind of result for the degree of operating leverage. Get ready. It's time to take your chance with corporate finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 525 Degree of Operating Leverage Alternative Formula tab in the Practice Problems section. Closing this back out, we're going to have our information up top, which is going to include year one information, year two information, units sold, total variable cost, fixed cost, total costs, total revenue, operating income. We'll use that information to do our calculations for the degree of operating leverage. We're going to do the alternative method, which is going to be the percent change in operating income divided by the percent change in sales. Then we'll do a slight adjustment to that where we'll have the percent change in the units sold, and we'll compare that to the original calculation we have been using in the past. So here's the calculations down below. This is the one we've been using in the past, basically contribution margin divided by operating income, otherwise contribution margin divided by contribution margin minus fixed costs. Same way to say the same kind of thing, but you need to know the contribution margin to do that, and that's something that you would have to do internally to the company, which you might, take the numbers and create a contribution margin type of income statement. It might be a little bit more difficult to do that if you're using a standard type of income statement, which you would be doing if you're external to the company and you don't have access to the data to put it in a contribution margin type of format. So you can still kind of try to figure out the contribution margin, but it might be a little bit more difficult from a standard income statement because it's not going to be in the format of sales minus variable cost contribution margin, but rather sales minus cost of goods sold is gross profit, and so on and so forth. But you would have then the change in operating income typically, or you can figure that out more easily, and the change in sales. That's why this alternative method may be useful if you're external to the company or if the company is not putting together contribution margin type of income statements for this type of analysis. So let's take this same information we have up top. Let's put it in the format of what we would think of as more of an income statement. And I will format it in like more of a contribution margin type of income statement in this case. But again, you can imagine picking up these numbers down here, the change in the operating income on a normal income statement, because by the time you get to that point on the income statement, whether it is a contribution margin income statement or a normal one, you're basically at the same point at that point on down for the income statement. Okay, so we're going to be picking up these numbers. I'm going to pick up the sales then. So we have the sales or revenue, which is the 405 for year one, year two, the 495. Then we want to get used to these difference calculations and these percent increase and decrease type of calculations as we go through this. Very useful to do this. Obviously, if we're thinking about the difference, we're just going to take year two, 495,000 minus year one, 405,000. That's a dollar difference of the 90,000. If I want to take the percent change, then I'm going to take that difference, that 90,000 change, divided by the original number, year one number, which is the 405,000. And that'll give us our percent change. If we move the decimal 2 places over, we're at 22.22% about. Then we have the variable costs, which are given here at the 180,000 for year one, 220,000 in year two. Same thing if we do our calculation for the change. We're going to take year two, 220,000 minus year one, 180,000, change of 40,000. We're going to divide that then by the original year, 180,000. That gives us, if we move the decimal place 2 points over, 22.22. You see this relationship is similar because, of course, the variable costs are going to be varying with relation to the sales. They'll change at a similar rate. So then we have the contribution margin. If we subtract these two out, the 405 minus the 180 gives us the 225. The 495 minus the 220 is going to give us the 275. The 50,000 can then be calculated two different ways. We can take the 275,000 minus the 225,000, that gives us the 50,000, or we could take the 90,000 minus the 40,000 to give us the 50,000. We once again have that same relationship, which would be the 275,000 minus the 225,000, $50,000 change divided by the original number 225. That's going to give us once again that 22.22%. Then we have the fixed costs, no change in the fixed costs, 70,000, 70,000, no change, no percent increase and decrease. Then we have the operating income, the 225,000 minus the 75,000 gives us the operating income, the 150,000. The 275 minus the 75 for year 2 gives us the 200,000. That once again is a difference of the 50,000, the 200,000 minus the 150, or the 50,000 minus 0. And then if we take that $50,000 change, we're going to say, all right, the 200, what happened here? We're going to say the 200,000 minus the 150,000 is 50,000 change divided by the 150,000 gives us the 33.33 change in terms of the operating income. Now notice again, you can see that operating income, if we had a normal income statement, it would be sales minus the cost of goods sold minus the selling and admin, which would basically get you to operating income. So you get to this operating income, basically either way. If you had the net income and you needed to back into operating income, you might take the net income, add back in the taxes, add back in the interest, and that would typically get you back up to then the same point. All right, so once we have that, then we can figure out our degree of operating leverage. We're going to do two variations of this new kind of formula we have down here, the change we're doing, the percent change in operating income divided by the percent change in sales. Now, when you're considering this, we need two time frames because we're thinking about the change of things that are coming from the income statement. And the income statement is a timing statement in and of itself. In other words, the income statement needs a beginning number and an end number in order to think about the income statement. So we have to see the change in something. We have to look at the performance statement from one period and the performance of another period to think about that percentage change. So to do that, let's say, okay, we need the percentage change in operating income divided by the percentage change in sales. So I could then take the percentage change in the operating income. That's going to be the numerator. I want to get the numerator and denominator on the right-hand side of our little column over here. We're going to put this together in kind of like a tax return type of format once again. We're going to have the same calculation over here to the right. So we're going to be doing the same stuff for the numerator. Then we've got the year 1 operating income. So year 2 minus year 1, that's going to give us the 150,000. And that's going to give us the 50,000 change. This is the same as this calculation we just did here. And then if I did the percent change, notice I'm just doing it in a vertical fashion, what we did in a horizontal fashion up top. So now we're at the 50,000, 50,000 divided by the year 1 number, 150, would then give us then the 33.33. So that's going to be the numerator. That's the change we have, the 33.33. Same on both sides of this calculation we're looking at. Then the denominator is going to be the percent change in sales, which we can also think as the percent change in units sold. And this might be useful because you might have the change in the units sold given in a practice problem or possibly in practice, or you might have the percent change in the total sales. Now, the reason these are going to result in the same is because there's a constant relationship between the sales and the units sold. So we can take the percent change in either one and they should be the same number here. So just to show that, we'll do that in both of these calculations. So we can say, all right, if we take the year 2 sales, that's going to be the 495. And if we take the year 2 units that are going to be sold, that's going to be the 110, which is given in the data up top, the 110. And then if we compare that to year 1 sales, the 405, so that's going to be the 405, and then we're going to get the difference of 90,000. If we take the units, it would be 90,000 units that we sold. then that's going to give us our change of 90,000 or 20,000. Obviously, the 90,000, same thing we got here. Then we're going to take that 90,000 divided by year 1, which will give us the 22.22. So we're going to divide the 90,000 divided by year 1 or by year 1 units. Either way, we're going to get to the same number, which is going to be the 90,000 divided by the 405,000 gives us the 22.22. And if we take then the 20,000 divided by the 90,000, that's going to give us the 22.22 as well. So now we've got our numerator and denominator. The denominator we look at in slightly different ways, and then we can do our division problem, and we can do it in a percent way, or if I convert this back to a decimal, it would be 0.3333 divided by 0.2222, and that's going to give us the 1.5 degree of operating leverage. So now we can compare this way to get the degree of operating leverage to what we have seen in the past. And so if we take the same information, I'm going to be concentrating in on year 1 now to pick up this information and get to basically the same 1.5. There could be rounding differences in these calculations, but now we're going to go back to what we've done in the past, taking the contribution margin divided by the operating income. So we're picking up the year 1 numbers, and notice this is a little bit tricky because again, when we use this percent change, we have to take basically the 2 periods and the change in the change between them. And here we're going to be taking the year 1 information, which is an activity statement from beginning to the end of the year. So we got the contribution margin. It's going to be the units sold. Units sold was the 90,000. Where's the 90,000? Oh, the units sold were the 90,000 in the data up top. Gonna have to go all the way up top to get the 90,000. And then we've got the contribution margin per unit calculated as the unit price, which was the $4.50. And then we have the units variable cost, which is $2. The 4.5 minus the $2 is going to give us the 2.5 to calculate our contribution margin, which is the 225,000. Now we could have also got that 225 just here. We could have just calculated it here. We calculated it the way we have seen in the past, and the data up top to do so is up top in our data here. So we have the contribution margin, and then we're going to subtract out the contribution margin minus the fixed cost or the operating income, which another way we can typically the line item would be. So we have the contribution margin, same number, minus the fixed cost, the 75,000. That's going to give us our contribution margin minus the fixed cost, otherwise known as the operating income. So here's the operating income. Now again, notice that in a normal income statement, you would basically have this number, which is basically operating income. You wouldn't really have the contribution margin unless you had a contribution margin income statement, or unless you took the normal income statement and broke it out in terms of the contribution margin. So this is kind of the problem area on why you might need an alternative calculation in practice. If you're outside of the company or inside the company and are not creating a contribution margin income statement for this type of break-even analysis purposes. And then we can take the numerator, 225,000 contribution margin, divided by the operating income, 150,000, and that's going to give us once again that 1.5. So that's the alternative method that you could use in a comparison between these two methods for calculating the operating leverage.